We hold these truths to be self-evident, that all men are created equal, that they are endowed by their Creator with certain unalienable rights, and that among these are life, liberty, and the pursuit of happiness.
Some homeowners are losing everything they had in equity, and their down payments have vanished in thin air. Now, today we're going to dig into the new home market collapse, and we'll take you guys under the hood to show you how bad a shape Lennar and D.R. Horton are really in. And that's the number one and number two new home builder. Then we're going to ask the very interesting question, which is, why did Warren Buffett just invest $1 billion in the new home market? Now, after that, we're going to dig in and unpack the existing home market implosion. And we're going to track down the top U.S. metro areas with existing home price decline. And a few of those metro areas are down over 20% from peak. These buy now, no matter what fanboy tyrants can no longer run from the data. Now, we're going to end this video by talking about the Federal Reserve's minutes and specifically what their concerns were regarding the housing market and Trump's newest firing of Lisa Cook for committing housing market fraud via mortgage fraud. And the question really is, guys, is there anyone left in the government that's actually honest? Now, happy Tuesday and welcome back to Real Estate Mindset, where we try to do everything we can to remind you our forefathers fought hard for life, liberty, and the pursuit of happiness. Mitch Vexler, happy Tuesday. How are you?
Good morning. Well, the market is doing what it's doing. Gold is actually up. Interestingly enough, the currencies are completely flat, so there's not much to do there. Same thing with the interest rates and the bonds. At the moment, it's flat. It seems like a very boring day where nobody's wanting to do anything. So that's okay. We'll take a break today, do something important, get a video done.
Yeah, I don't think that's taking a break. Personally, I think it's hard work. But let's start, Mitch, by going into the new home market collapse. And I have some extremely alarming data to show you. This article coming to us from Wolf Street. This was released yesterday, August 25th, titled "New Single-Family Home Prices Drop Further as Inventory Glut Grows. In the South, Inventory for Sale Hits New Record." Selling price has dropped by 19.5% from peak 3 years ago. And I'm going to tell you guys right now, that is wrong. It's more like 30%. Remember, they changed the data. They changed the way that they were making up median sales price. So it looks like it's only down 20%. But I'm telling you, it's more. New single-family homes for sale at all stages of construction rose to 505,000 homes in July. That is the biggest since October of 2007, right before going into the global financial crisis. But back then, during the housing bust, inventories were on the way down as home builders are trying to stay alive by cutting back construction. Right now, that's not happening. So the prices are plummeting, inventory is skyrocketing, but they barely slowed down on construction. Absolutely wild. Compared to a year ago, inventories were up 8.1%. However, compared to July before the pandemic, July of 2019, inventories were up, listen guys, by 54% pre-pandemic. So they're taking pre-pandemic data before we got into this mess, and we're 54% higher than that amount. And here's a graph right now. Now, it's very important to understand this is all stages of construction. And look at where we're at, 550,000. Again, going all the way back to 2007. And then that started absolutely plummeting into recession. Right now, again, it's not doing that. It went down a little bit right here at the end of 2022 with deflation, but construction is still going up. Very interesting to see that. When we look at the actual completed new single family houses for sale, you guys can see that we're at about, let's see here, about 2009 highs. That's been going straight up. Again, the deflationary period right here, but the Bank Term Funding Program came, as well as Inflation Reduction Act and all kinds of other inflation, and that started going back up. Now, this is also interesting. So even with the overwhelmingly insane buying incentive, prices are falling even without including those incentives. The median contract price dropped by 5.9% year over year to $403,800 in July. And again, you guys, that's without including the incentives. When we include the incentives price and when we include the old way to calculate median sales price, prices are probably down 30, 40%. right now for new homes, if you take those things into account. Here's the real issue with not reporting the incentives, which you are required to. They're called IPCs, interested party contribution, and seller contributions. Fannie Mae and Freddie Mac have strict guidelines, and you're supposed to remove that from value so that we understand what the true value is, because the U.S. Census Bureau doesn't pick up incentives. It says right here, the Census Bureau tracks sales prices of new homes by the prices written into the purchase contract that buyers have signed. Okay. The contract prices do not include the cost of mortgage rate buydowns and some other incentives. With the cost of the buydowns and incentives included, home prices fell far further. These contract prices overstate the effective sales prices and understate the effective price drops. Do you see, guys? And still, they've been coming down, even with massive incentive costs not included. The price explosion during the pandemic, where people were willing to pay whatever, had led to an explosion of profit margin at home builders. Those profit margins are now getting trimmed back, and net profits have fallen. And here again is the median sales price for homes right here. And remember, you guys, this was up to 500,000. This is where my arrow was at. So it was way up here. So the reality is if they just would not have changed the way that median sales price was calculated, home prices would be down again close to 30%. And then when we add the buying incentives to that, that's another 10 to 15%. So new home prices right now, again, just looking at all those things, you can make an argument that they're down about 40% right now. Again, taking in the buying incentive for all the haters, listen to what I'm saying. When you take out the buying incentives, the overwhelming amount of buying incentives, and you go back to the original way of calculating median sales price, they changed that in 2023. Including incentives, home builders have been trying to stimulate demand with big incentives and costly mortgage rate buydowns. Lennar disclosed that its incentive spending jumped to 13.3% of revenues in Q2, primarily due to mortgage rate buydowns, the highest incentive spending rate since 2009. So add that 13.3% to the 19.5, and you guys can already see that's over 30%. Just right there. That's the highest incentive spending rate since 2009. And again, we're absent a so-called recession, right? Now, Lennar's average sales price dropped to $389,000, down 19.5% from the peak in Q2 of 2022, and is back where it had been in Q2 of 2020, having given up the entire, listen, this is so important that you guys understand, this is new homes. They have given up the entire 2020 and 2022 price explosion, gone. It's completely wiped away. Average selling prices include the incentives. And look at this downward trend right here, you guys. So here's Lennar's average home price. They're not even using median. And you guys can see the run up of 24%. In order to lose the 24%, it only took about 19%. So you don't lose 24% once you've gained it. You only need to lose about 19%. So it's wiped away. It's completely gone. And that's Lennar. When we look at D.R. Horton, here's what it says. D.R. Horton reported that the average selling price per home sold declined by 3.3% year over year, but also declined 11.1% from the peak in Q3 of 2022 to $369,600 as of the third quarter ending June 30th. And again, here it is. Here's the run up, massive run up, 41%, down 11.1%. But when you take the buying incentives out of there, and when you go back to the original way of calculating median sales price, they're also down over 20%. Sales have hung in there thanks to the deals. Sales of new homes fell, ouch, 8.2% year over year to 56,000 contracts signed in July. Now think about that again, you guys. Okay, so massive incentives, home prices are falling with demand. So it's no longer working is the point. And the same thing is happening in the existing home market. And we'll show you guys that here in a second. Now, some efforts by home builders to stimulate demand via lower prices, mortgage rate buydowns, and incentives have worked to some extent to prevent the kind of plunge in demand for existing homes. But that, again, is changing. Home builders have to maintain their business, and they have to find the mix of price points and incentives at which they can sell, and they sacrifice some of the fat profits to get there. They cannot decide to just outweight this market. So they are forced sellers. They are always for sellers. Just to remind you guys, Warren Buffett's Berkshire Hathaway invests nearly $1 billion in home building giants. And this came out August 19th, about a week ago. Now over to the people's champion, Mitch Vexler. And by the way, thank you for making the people's bill to abolish property taxes or repeal. I know that's legal language. We got a lot more updates for you, by the way, you guys, on the bill to abolish property taxes or repeal. But my question for you, Mitch, is why do you think that Warren Buffett invested $1 billion in U.S. home builder stocks if they're plummeting in prices and there's apparently a lot more turmoil coming to them in the future? Why would Warren Buffett not wait for the prices to go lower for these new home builders?
Well, believe it or not, the Warren Buffett issue is exactly tied to the non-reporting of incentives. So let me see if I can put these two issues together. So Warren Buffett, what people do not realize is that he is a specialist in arbitrage. He has the ability to sell puts below these public companies, which means if he sells a put and his put gets hit, he bought the stock at a much deeper price. So what's really going on here is he just dropped a lure in the water. And he'll start looking at it because generally speaking, Berkshire invests for the long haul. Well, if you're going to arbitrage home builders, let's say it's just two home builders for the sake of conversation, what better way to do it? You drop the lure in the water, you wait for the arbitrage situation, a dip in the market, you sell puts below, and if you get hit, you got the stock at a cheaper price. Over and above that, let's say the home builders that he's looking at get into trouble. Maybe he knows that they're already in trouble. Well, they would reach out because they now know that he signaled that he's interested in the company. So they would reach out and say, we're in trouble. Let us sell you warrants, help finance our position out of this mess. Warren Buffett gets the warrants, i.e. Goldman Sachs, deja vu. And then he's now picked up companies at extreme discount. He's playing a whole different game than the rest of the world is paying attention to. So that ties right to the issue of the incentives that, Travis, you were just speaking of. Not reporting incentives is the equivalent of creating bad data. So in the multifamily world, I just typed this out a minute ago, that's like determining or not determining what the net effective rent is based on the concessions. So if you've got a rent at, let's say, $2,700 a month, but you're giving away 90 days or 120 days of rent to get that tenant in, well, that's a concession. And that concession, if you're hiding it, means the equivalent of 3 months, right? 90 days, 3 months divided by 12. That's a 25% reduction, which means your net effective rent has been reduced. Well, the ramifications of a $2,700 reduction coming down 3 months, so it's $2,700 per month, you're giving away 3 months to get occupancy, that ends up in a reduction of value of $135,000 per unit. Yes, it is fixed at that point in time. However, no one knows how long that time period for the discount will exist. So that's $135,000 fixed at that point in time, all else being equal. The problem with that $135,000 reduction in value per unit, that's the equivalent of a 50% reduction in value of that multifamily unit. You built it for $275,000, you get a $135,000 reduction. You're now down 50% because you hid the evidence. And the net result is the creation of bad data. How much do you want to bet Warren knows everything that we're talking about here? He studied these numbers inside out and backwards. He knows exactly what he's doing. And all he's doing is saying there's chum in the water. I'll drop a lure. Let's see what happens.
Wow. Wow, man, that's an outstanding breakdown. And speaking of bad data and speaking of data propaganda, I'm going to play you guys a video from November of 1999. Now, you guys know that shortly after November of 1999, in the year of 2000, we had a recession from the stock market bubble or dot-com bubble. So I want you to listen to this video. It's 2 minutes long, and I want you to see if you can find any similarities, such as the GPD being 5.5%, unemployment only being 4.1%. But I want you to listen to this video and understand that shortly after this video was made, all hell broke loose in the economy. So you can't trust data because they use it as propaganda.
It's the day after Thanksgiving, and typically that means sounds like these. Malls across America are teeming with holiday shoppers, buying everything from purses to Pokemon.
I think every year I end up spending more each Christmas, and since I have a few more dollars in the bank, I probably will spend even more this year too.
And lately, American consumers have been shopping with even more vigor than usual.
I think everybody's in a good mood. By the looks of the mall, it looks like it's full of people.
As we approach the once-dreaded date of Y2K, the U.S. economy continues its seemingly inexorable expansion. Thanks to spirited consumer spending, the economy barreled ahead in the third quarter at a growth rate of 5.5%. This pushed the gross domestic product, the total output of goods and services, to $8.9 trillion. The quarter was the best for growth since the end of last year. And today's announcement that personal incomes shot up at the highest rate in 5.5 years comes as the nation's unemployment rate remained near a 30-year low. It now stands at 4.1%. Meanwhile, initial jobless claims fell 13,000 last week, suggesting increased demand for workers. No surprise, then, that the University of Michigan's Consumer Confidence Index was up at 107.2, a 4% rise from mid-October. The only slight shadow in the picture appears to be inflation, which, according to one Commerce Department measure, is up at a rate of 1.7% for the first 3 quarters of this year, compared to 1.1% for the 3 quarters previous in 1998. Presumably, to keep that inflation in check and slow the economy somewhat, the Federal Reserve last week raised interest rates for the 3rd time this year.
$54.
But consumers seem undeterred. In the current 4th quarter, forecasters see economic growth in the 4 to 5% range, most of it driven, as usual, by consumer spending.
When Melody Wright says, vote with your dollars, that's what she means. Because remember, you guys, 70% of GDP roughly is from consumer spending, you and I. And they don't track whether or not that's our dollars or credit card debt. They said the same thing right before recession in the year of 2000, the same thing that they're saying right now. They say the same thing over and over and over again because they know that, unfortunately, we're not going to do anything about it. Now, hopefully, that's starting to change. Let's jump in now to existing home prices. This article, also by Wolf Street, this came out a few days ago on August 23rd, titled The 12 Biggest Cities with the Biggest Price Declines of Single-Family Homes, and that's down 10% to 23%. And remember, you guys, the housing market is bifurcated. There's existing homes, there's new homes, there's Texas and Florida, and also New York and Maine, completely different housing markets. So remember that when we're reading this. Each housing market moves on its own drummer, except the unaffordability bubble and fraud bubble that's going on in every county across the nation. In some cities, prices of single-family homes have continued to rise, but in others, they started to tank in mid-2022. Have you guys heard that before? Who's been telling you that the whole time and been getting roasted? I have. Thank God now they're cleaning up the data, and you guys see that we were right this entire time. Or more recently, and that list of cities with dropping prices has been getting longer. And the list of cities with price drops of 10% or more has been getting larger too. Here's the top 12 biggest cities with home price decline. And we're going to go into this in more detail, but the number 1 city, I'm really surprised that this is number 1 now. This is actually beating Austin, and this is from the peak. Remember that. This is not year over year. So Oakland, California, down 23%. Oakland, California right now is crashing with not only transactions, but home prices. I think we can say if it's down 23%, can we finally say that? Oakland is crashing now. Number 2, Austin, which is also crashing, is down from peak 23%. Plus add the 8% it takes to normally sell your house. These people are absolutely gutted. They have lost everything. The cities you guys see here, these people have lost everything. This is not new homes, you guys. This is existing homes, okay? Number 3, right down from where I live, New Orleans. New Orleans is down from peak 18%. Cape Coral is down 18%. That's in Florida. Number 5 is San Francisco, California. You guys see it's always what? Texas, Florida, California. And then Birmingham comes into the picture, Alabama. That's down 15%. Fort Myers, Florida, down 12%. Here's Washington, D.C. on the list, which leads the nation in job loss. So it's going to be interesting to follow Washington, D.C., down 12%. Number 9 is Denver, Colorado. We made a road trip there. That's down 10%. Portland, Oregon, actually down 10% as well at number 10. Phoenix, Arizona, we drove there as well, down 10%. And number 12 is Sarasota, Florida, down also 12%. Now, what's interesting is here's the month over month right here. Okay, much different. So you got to look at the month over month. Also, here's year over year. Now, this is also pointing out condo prices have skidded downhill faster than prices of single family homes. Okay, so we're just talking about single family homes here. Going into detail, looking at Oakland, again, down 23% from May 2022, down month over month, 1.5, year over year, 9.8%. And they put since 2000. Now, why wouldn't they have used the pre-pandemic prices? If you really want to compare and show people what's going on right now, you would use just 2019. But they didn't do that. They used the year of 2000 to try to sucker you back into the house market. Look, because it is up. Home prices are up 285% since the year of 2000. Okay, so good job, guys. A quarter century ago. Thanks for giving us the data on a quarter century ago. Good job. Oh, by the way, that actually follows the last video we just watched. But look at the trajectory. This is important, guys. Can you see the crashing housing market now? Here's prices. Okay, this is according to Zillow. See that peak? And you see that crash right there? It's crashing in Oakland. Look at Austin again. Just like Oakland, down 23% from peak in June of 2022, down 0.8% month over month, 6.7% year over year, up 168% since the year of 2000. But look at this trajectory. You can clearly see the peak and the price crash happening in Austin. And you guys, keep in mind, they gave up all of their gains. These cities and metros have given up all of their profit since the pandemic. Here's number 3, New Orleans, again, down 18% from peak, down 0.1% month over month, and 3.6% year over year, up 108% since 2007. Look at the trajectory again in this chart here. It is crashing. They have lost so much. Here's Cape Coral, down again 18%, 1.2% month over month, and a whopping 9.6% year over year, still up 220% since 2000. And again, look at the trajectory. That's also crashing in prices with no floor in sight. Now, here's number 4, San Francisco, down 16% from peak, only 0.4% month over month, and only 1% year over year, up 233% since the year of 2000. And you guys can see it peaked here, went down, and then started plateauing. So I suspect San Francisco is going to have another massive downward swing in prices. Only time will tell, but it has given up all of its gains from pre-pandemic. Birmingham, Alabama, again, down 15% from peak, 0.1% month over month, and 4.8% year over year, only up 32% since the year of 2002. Why they decided to change the data set in the middle of the data presentation, to me, signals some type of bias. You guys can see it peaked here and then plummeted downward, little bit of seasonal increase, then plummet downward, little bit of seasonal increase, plummet downward, little bit of plateau from seasonality, and then it's plummeting downward once again. When we dig into the hood a little bit more about Washington, D.C., I think this is important to understand because remember, I've been saying, hey, Washington, D.C., from a price standpoint, hasn't crashed yet, but they're probably going to start crashing rapidly because over 200,000 job cuts have been happening in the District of Columbia, which is Washington, D.C. This came out yesterday, August 25th. Housing market headlines this spring and now summer indicate selling prices are falling in more metropolitan areas and by 2 measures. The important measure is year over year, and on that account, the D.C. area market is still holding up. So it's in the top 12, but they're saying it's okay, guys. If you look at the year over year, it's not that bad, but you gotta look through the headlines and through the nonsense. Redfin reported year-over-year median selling prices were down in 29 of the 50 largest metro areas in July, the highest tally dating back to the company's 2012 records. Can you guys see it now? In Washington, D.C., home values are down 0.5% month over month, but they're still up 2.65% year over year. But if you want to really look at the big picture, they should have had peak here. So it's not showing you how much they're down from peak, but this goes on. At that pace, it would take a long time for most existing homeowners to actually lose money on their sale, but not if they purchased it over the last 3 years. Use things in context, whoever's writing this, please. In the DC region, just 2% of current owners are owing their lender more than they could sell their property for, but 35% are considered equity rich, able to sell for at least 50% more than what they paid for, according to Adam data. But this is also not taking into account the cost that it takes to even sell your property. Remember, you guys, normally, okay, not always, but normally it costs, we'll do a range here, 4 to 6% to sell your house from the realtor commission standpoint. But it also costs another 2% in normal closing costs like property taxes, title insurance, escrow costs, and things like that. So the total is from 6 to 8%. So when they add the realities of what it takes to sell your house, I bet you it's a lot higher than 2%. Either way, Mitch, I mean, we talked about new homes. People lost all their equity, whatever they gained through the pandemic. Most people, not all. Same thing's now starting to happen in major metro areas. We're not even looking at the areas outside of major metros. Okay, those are also declining. But my question is, you know, if homeowners are purchasing these homes based on what realtors are saying, home values just go up, they just go up. Do you think that some of these homeowners who lost everything, including their down payment, have a right to sue their realtors? And this is a warning to realtors as well. What do you think about that, Mitch?
I raised that issue with a group that asked me to do a video for them, and they've got a very large realtor presence across the United States and Canada. And if you inadvertently get your client into a bidding war when these facts are known and you do nothing to state, if you want, as the buyer, to obtain that house, no matter what, because that's what you and or your spouse want, then that is on you. The problem is that the realtors did not give and or obtain a statement that says, we've warned you that you're entering into a bidding war. It's on you, the buyer. So there could be certain circumstances where, yes, that would occur. Could they be sued? Yes. It would probably come down to a judge deciding on a caveat emptor, buyer beware. The problem that we've seen in multiple cases, just as what you, Travis, saw the other day with that couple who bought the mobile home, they get steamrolled by the system. You buy a mobile home for $120,000 and it turns out that it's got a $385,000 fraudulently assessed value, which went out by virtue of mail frauds through the Postal Service. But the point of the matter is, they were getting steamrolled by aggravated perjury coming from the registered professional appraiser working for the CAT. Mom and pop can't defend about this because they don't know what it is that they're facing. So the net result of all these issues is that how can mom and pop defend themselves and even say, well, I overpaid? How do they know what to look for when they're being bombarded by, well, buy this house today, you get this amount of discount? They don't know what the incentives are. It's one problem after another after another. The combination which is designed to fraudulently induce mom and pop to buy something that they can't afford. And you've even seen that on the mortgage applications. Well, no money down, zero down. We'll write you a check at closing. These are all things that are done to induce people into doing something that they can't afford. So would it be wise for a person who's been duped to sue the realtor? Well, again, caveat emptor, beware of what you're getting into. Sometimes yes, sometimes no. I want to point another thing out though. With regard to the year 2000 and that video, it's a very interesting thing because do you realize it was 1.1% to 1.7%? So mom and pop look at that and say, well, what's a big deal? It's less than 2%, right? Well, the big deal is 1.7 minus 1.1 is 0.6. 0.6 divided by 1.1 being the denominator, that's a 54% increase in inflation in less than 12 months. That is a big deal. So where I'm going with this is mom and pop have median household income. And median household income, as I've been jumping up and down about, is the only thing that matters. If your median household income is flatlined and inflation runs at a 54% increase year over year. Okay. That means that your purchasing power of your median household income, what's left in your pocket, is disappearing. It's being stripped. Then when you add on top of that, the outstanding school district fraudulent bonds for which they raise the central appraisal district money comes out of your pocket. That is your money on your median household income being equity stripped straight out of your mortgage. The point is that the inflation, which is self-induced, this is man-made fraud. This is government-induced fraud. That inflation is directly correlated to your decreasing purchasing power. These things are all correlated.
Well said. I'm glad you picked up the inflation in that video. And speaking of government-induced fraud, let's move on to talk about what's going on with the Fed, the recent firing of Lisa Cook or whatever. I think it's Crook. I'm not sure. And before I do that, let's listen to a video of Bill Clinton. And this is only about a little less than 2 minutes. And he's going to explain why it's important for mom and pop to bail out banks. Okay, so I'm playing this for you guys because I want you to understand that they have been lying to us for decades. What's happening right now is nothing new, and the apathy is getting worse. Listen to this.
The question people are asking out in the world, and you hear these congressmen stand in the Congress and talk about, my constituents want to know why I should write or at least be billed for more than $2,000 for each and every human being in this country to help bail out these folks who were so reckless with this money.
Well, you don't want to do that. We have to be careful not to have unjust enrichment, and I think the members of Congress have made that clear, and both candidates for president have made that clear. They put out a joint statement, I thought, which was encouraging last night. But here's how it would work. If you want to keep a company afloat that's made some improvident investments, some of them, one, Lehman Brothers was allowed to fail, go into bankruptcy. And some of those same people you're worried about are taking up their assets at bargain basement prices. With AIG, the big insurance giant, I think that's going to be more typical. The government did loan them a lot of money, but they took an 80% ownership interest in the company, and they had to pay back with a pretty hefty interest rate. Mm-hmm. So I think that by stabilizing that company, the taxpayers will actually wind up making money. We made money when we helped Mexico. We made money in the Chrysler bailout. And in more to the point, in the Great Depression, when we kept 1 million people in their homes, the taxpayers made money. That's why I think the Congress should take a day or two to analyze this to make sure that's the way it's done, that instead of subsidizing the undeserving, we use this to stabilize the economy as a whole and help those homeowners that are hardworking people.
Talk is cheap. Trust if you want, but I'll caution you, trust but verify, because math and history matter. This article came out on the 23rd, so a few days ago, stating the Fed is starting to worry about the housing market. They've actually been worried this whole time. I have clips of Jerome Powell actually warning us. They're just talking and acting like they're worried now. While markets focused on the Federal Reserve's monetary policy, minutes from the central bank's last meeting revealed concern among policymakers about the housing market, which has been raising alarms on Wall Street as the slowdown drags on. Fresh data also points to more worrying signs, especially for new homes. Minutes from the Fed's earlier meetings didn't include such alarms, but that changed during the July 29th through 30th gathering. Participants observed that growth of economic activity slowed in the first half of the year, driven in large part by slower consumption growth and a decline in residential investments, the minutes revealed. But Fed officials were also specific about their housing market worries, suggesting they were starting to pay more attention to the data, but the data is propaganda. So what data are they paying attention to? Not only did housing show up on the Fed's radar, policymakers flagged it as a potential risk to jobs, along with artificial intelligence technology. In addition to tariff-induced risk, potential downside risk to employment mentioned by participants included a possible tightening on financial market conditions due to a rise in risk premiums, a more substantial deterioration in the housing market, and the risk that increased use of AI in the workplace may lower employment. If that wasn't bad, Trump says he's fired Fed Governor Lisa Cook and moved to control U.S. Central Bank's board. But what's interesting, guys, is when we look at the letter from Trump, and I'm going to try to read this to you, okay? So this is from Trump that was sent yesterday to Lisa Cook, okay? And by the way, she's allegedly committed mortgage fraud, just like Ken Paxton, which is the Attorney General of Texas, also potentially committed mortgage fraud. And the thing with mortgage fraud is it doesn't go away. And if it's an FHA mortgage, it is a felony. Pursuant to my authority under Article 2 of the Constitution of the United States, the Federal Reserve Act of 1913, as amended, you are hereby removed from your position on the Board of Governors of the Federal Reserve effective immediately. Holy smokes, that's strong. The Federal Reserve Act provides that you may be removed at my discretion for cause. I've determined that there is sufficient cause to remove you from your position. As set forth in the criminal referral dated August 15th, 2025 from Mr. William Polte, Director of the Federal Housing Finance Agency, to Mrs. Pamela Bondi, Attorney General for the United States, there is sufficient reason to believe that you may have made false statements on one or more of your mortgage agreements. For example, as detailed in the criminal referral, you signed one document attesting that a property in Michigan would be your primary residence for the next year. 2 weeks later, you signed another document for a property in Georgia stating that it would be your primary residence for the next year as well. It is inconceivable that you're not aware of your first commitment when making the second. It is impossible that you intended to honor both. Mitch, I have a specific question for you. Would closing down the entire Federal Reserve, not just firing Lisa Cook, but would closing down the entire Federal Reserve help the housing market, and why or why not?
In my humble opinion, the Federal Reserve is nothing more than a make-work program for wayward economists. There simply is no reason mathematically to have it there. It's been proven all the way since its inception. Every time they make a decision, they're on the wrong side because they're not there for mom and pop. They're there to protect the banks and stop bank runs, but they've morphed into something that's just out and out evil. And in my humble opinion, it needs to go. And to that point, with regard to President Clinton's comments, the compound cumulative effect of the fraud is new by the nanosecond. The interest outstanding grows by the nanosecond as seen on the usdebtclock.org. Lehman Brothers went bankrupt in 2008. Now, if you apply the rule of 72 to the then US national debt, and you start adding in the derivatives and all the monkey business going on under the hood, then you add in the newly created outstanding fraudulent school district bond debts, you end up where we are today, which coincidentally is shown in the movie Margin Call. What happened in that movie, in that boardroom, is exactly what is playing out as we speak. That's where we are. And with regard to Bill Pulte, that's from Pulte Homes. He set out a process to try and clean house, and he is overseeing Freddie Mac and Fannie Mae. Well, I sent a letter out to Mr. Pulte about 2 weeks ago outlining the potential problems with the bonds as a result of Freddie Mac and Fannie Mae having mortgage-backed securities on their books. What is the true value of the underlying assets of those mortgage-backed securities, assuming a 40% reduction from face value of the bonds? Everybody should watch that movie Margin Call. That is where we are.
Well said, Mitch. Now, in conclusion, the solution to all of this, y'all, is you and I and Mitch and every single person that wants to make a change. Now, we've created a mechanism for you guys to help. The first one being, okay, first of all, we are trying to abolish property taxes. Mitch has a bill, but before we go over the bill, I want to remind you guys, we have a new Facebook group, Abolish Ad Valorem Property Taxes, Texas Horse Barn. So if you guys want to discuss what's going on here in Texas and what's going on with property taxes, come here. And by the way, we've stopped the blocking and suppression because Russell Bennett, we're on to you. Which brings me to the next thing. Go to Mitch's website right here. Mockingbird Properties /DCAD. We have all of the evidence, all of the presentation. And if you guys want to see the people's bill, okay, the bill to repeal, the bill to abolish property taxes, it's all there. And essentially, I want to make a quick point, okay? The reason why we didn't mean to go at someone that's supposed to be a pioneer at ending property taxes. It's just their bill doesn't work. And we have to raise the red flag and we have to be able to talk. But instead of us being able to talk about their bill, they blocked us, suppressed us, and then slandered us and made up a whole bunch of lies, right? Someone that's supposed to be on our team is doing that right now. And I'm keeping screenshots of everything. So anytime you want to talk about it, I have all the proof here. Call me out on that, Russell. But I don't want to be mean, you guys. I want to end property taxes. The way that the bill works, the people's bill works, is not only are we ending property taxes, there's also mechanisms inside that bill that requires the government to be transparent, to give access to us, the public. So really good things. If you guys want to know about the bill, everything is going to be linked in the description. Don't forget to follow the links there. And other than that, guys, happy Tuesday. Hope you guys have a great evening. And if you guys are out there trying to end property taxes, you know we wish you luck and we hope we all win.